Hey everybody, it's Erik co-founder, partner of Village Global, a network-driven venture firm. And this is Venture Stories, a podcast covering topics relating to tech and business with world-leading experts. Hey everybody, welcome to another episode of Venture Stories by Village Global. I'm here today with a friend, Marco DeMeireles, a partner at TCG. TCG is a new $700 million multi-stage investment firm dedicated to building consumer businesses. Marco, welcome to the podcast.
Erik, thank you for having me.
So Marco, why don't you give a little bit of the background on yourself, how you came to TCG and where you're focused on in TCG right now?
For sure. So about in 2010, two of my three partners, there's four of us total, got together to start a holding company called the Chernin Group. Peter Chernin had previously been a co-founder of Hulu and seen this thesis around direct-to-consumer immediately impacting how individuals and families were consuming entertainment. And as part of that, formed a bigger thesis in and around media brands and broader consumer technology. In 2012, they raised a significant amount of equity. My other partner, Mike, joined them, bringing a bunch of operating DNA and expertise to the team. And during the period that they were together from 13 to 18, they invested in over 70 companies across early stage seed through growth, and even did control buyouts in businesses that you would know, like Barstool Sports. In parallel, I was actually building my own growth equity and venture capital business at a large hedge fund called BAM, where I did everything from thematic sourcing and building up a team, setting up a San Francisco operation, raising third-party capital, taking board seats, and really leading 14 or so core investments across 5 or 6 different end markets. And during that time, in parallel, got to know Jesse through a friend, Adam Bain, and Rich Greenfield, who is a well-known media analyst, when Rich actually invited Jesse to join a event I hosted in Jackson Hole, Wyoming for an executive offsite. And over time, when I was sharing deals and ideas with Jesse, and they experienced significant liquidity events and selling auto media to AT&T for $1.2 billion, we started kicking around the idea of joining forces together to build a much bigger, stronger business. And so I joined the three of them in 2019, and TCG came together in 2018. During the year of 2019, we raised roughly $710 million in outside capital to scale the business, which was a totally independent investment firm with deep roots in what the Chernin Group was doing in its prior iteration.
$700 million. How do you think about portfolio construction with a firm that big?
Yeah, so we think about the world in terms of a few different ways. One is the way that we attack markets and think about businesses and teams to back is very thematic. And so we'll do a lot of work in industry to come up with a view that we think is nuanced and differentiated in fertility. The question we overlay on top of that is, what is effectively the best risk reward in the space to express that view that we think would be in the best interest of our investors and our team. And that means that using fertility as an example, you can roll up clinics like TA Associates and Lee Equity Partners have done in the past in a very profitable way. You can back growth businesses with large $30 million plus checks, or you can do traditional Series A where you have a different level of ownership and risk reward that you're playing for without actually paying a growth price. And so we think about it in terms of risk reward, but the way that it manifests itself in portfolio construction and expressing that view is 60% of our investments, call it our minority in the sense that they're a mix of growth or venture. 20-ish% of that I would put in traditional Series A investing. This is, 4 on 12, rolling up the sleeves, early team, but product market fit and building an impactful business. So things like that we've led in the last year are Daddy, a sperm banking business, which we can get to, or a little bit more mature like Shop Shops, which is a 3-sided live streaming marketplace. On the growth side, these are businesses where they're fairly well scaled. It's typically represented about 40% of the portfolio, and they're in an industry where we've developed what we think is a non-consensus view, and there's still a few turns of return to come. And so things like Zola in the wedding registry industry, which we can unpack, represent that in our portfolio. And over time, we expect that to be roughly 40% of our business. And on the control side, it's really about risk reward as well, where we're expressing that view. And that looks like a majority investments where oftentimes there's 10 plus years of founders will continue to have a shot on goal, but there's a mismatch in the capital structure or some sort of intricacy that makes it attractive for us to be a bigger, larger partner so that they can take a better swing on the back nine and play out their thesis. And, our partnership, which we didn't mention, is a little bit different in that the majority of us have been career operators and creatives. And, there's me who's more of the career investor, although building a venture and growth business, you could say, is operating in one respect. Right. So we think we're particularly good at that.
Are you guys less ownership focused and more probability weighted multiples focused then?
Yeah, I think it's less about fixed constraints actually on either and more about where do we think the business can go from here and what are we playing for, and making sure that core return that we're underwriting comes from something that exists, right? In the case of like a Peloton, just to use that example, it's making sure that you believe there's a couple 100,000 units of bikes in the world today, and the core return comes from, that number growing to 1 million plus over time. And I actually think it can be 3 million plus over time of an install base. Then having the next leg of probabilities, to your point, being new products like treadmill and a few of the things that they've announced, and the next leg of that stool. But I think for us, we think about where are we taking the risk, and is that the right way to think about risk?
One of the things we've been going back and forth on is your latest thesis, which is owning a life stage, i.e. getting married, having a baby, end of life, i.e. funerals. Unpack that thesis, how it evolved and where that might lead you.
Yeah, and I actually think if you maybe step back a little bit, we've seen this at a macro level across verticals for consumer, right? So even in gaming, you could think of a business like Roblox as really owning that cohort of young Gen Z individuals for a finite period of time, but that's a very, very profitable big business as I think And so, in our portfolio, the way that we've expressed that initially is through our investment in Zola. And so I've been an investor over the last few years across a couple of different rounds. And what actually got me excited is if you look at the first generation of these businesses, things like Wedding Wire, The Knot, Martha Stewart, they're actually all ad-based models, which have inherently a subset of challenges, let alone like the valuation multiples and what they actually trade on and what they're worth. And if you think about these newer platforms that have been built to own this life stage of weddings for the cohorts that exist today, which are largely millennials and Gen Z, Gen X, Zola, the way it operates is a much different approach, right? It's digital first, it's mobile at every step, it's simple, it's enabled by dropship, they provide guidance and community, and it's all integrated in one place, whether it's features like guest list or website building to closing the loop on things like invitations. But before you even get there, the thing that is really, really special about Zola is unlike Wedding Wire and The Knot, there's a much more superior business model. And it's even, compared to traditional e-commerce, right? So traditional e-commerce is, if you look at businesses like ASOS in the fast fashion world, they have 30% plus return rates, right? Because you're just buying stuff online, trying it, and then shipping it back. That crushes your gross margins. Because my partner and I have actually picked out the things that I want Erik and his friends to buy for me, there's a much, much, much lower return rate. And so you have a better gross margin profile. And look at the stocks that are publicly traded and express that in their commentary with analysts like Williams-Sonoma, you'll see that the highest margin lever of their e-commerce business is actually their registry business. The other thing is, if you think about one of the more interesting things we focus on is ramping paid acquisition. We think we know marketing really well. And if you think about traditional e-commerce, right, it's hard to drive purchase behavior because if you think about most models, they're largely driven by paid acquisition spend. But because I'm inviting Erik to my wedding, there's built-in intent where my pushing out of that invite to my registry is actually pushing you to buy on Zola. And so the marketing equation is much more nuanced, but in a more profitable way. And then the other thing is if you look at businesses like a Stitch Fix, right? They're seasonal assortments. They change the jeans at every turn of the months and flavor. And that leads to a people-heavy operation, right? And if you think about what people are buying on the wedding side, it's more of an evergreen assortment in e-commerce sense, meaning it's blenders and home goods and things that are generally staples. And because of that, the infrastructure costs of running a Zola hybrid marketplace are meaningfully lower because you don't have 60, 70 people in your merchandising department turning SKUs. And then the other part is obviously, the cash flow, right? And so, just to simplify it a bit, a good way to potentially get divorced is to do your registry the night before. And so most people actually do it months in advance, and most of the gift purchasing happens 4 or 5 months in advance. And Zola collects the cash when Erik buys me a gift before the gifts are shipped. So they're building a float similar to Airbnb where there's a prepaid component effectively before going cash out of pocket. And so when you combine that hybrid marketplace, you have a very, very good contribution margin positive core business that you can then layer on these other things to answer your question and own the life stage. So what are the other things, right? And so Zola knows that I pushed Erik and my 150 friends to my website. They know what you bought me, and they have my social graph. So because they've seen those emails uploaded, and when you buy that for me, to close the loop, instead of doing thank you notes in the traditional sense, they already have the data that connects what Erik bought, when he bought it to that specific good. And it simplifies the thank you process to a much more drag and drop like model where I'm not handwriting notes and tracking down all Macy's and Bed Bath and Beyond receipts to see, what people got me and when, right? It's actually all there. And so if you look at the attach rate, what I think of as a new business, it is significantly higher than most people will expect for something like invitations, which by the way, have 70% plus gross margins and have been very, very profitable standalone businesses. They already have this captive intent. And then if you think about things like, just to share that I think has been recently announced, businesses like honeymoons, right? That's like, an 11 billion plus market. The average couple in the US today spends over 3,000 plus. Zola's cohorts are meaningfully higher. And so you also have a favorable margin profile that's integrated with the platform. And if you look at how the NPS of this business, 90% plus of the couples that have registries with Zola actually say they book a honeymoon with them. And so part of that product, and that's one of many things to come. But I think when we think about owning a life stage, it's really nuanced because you want to own it in a very contribution margin positive way that creates these little loops on the subsequent businesses you built, some of which we've described.
To better understand the thesis is that if you own one life stage, you have wedge into owning other ones, or that that life stage is so important that you can get better margins on it, or what is it about the life stage specifically that makes these better, or the lock-in is higher, or what is it that makes these better businesses?
I think it's the life stage combined with market, right? So if you look at the 3 largest players historically in the market have been Bed Bath & Beyond, Macy's, Crate & Barrel, right? Like, I'm not sure the last time any of your friends who've gotten married have been to one of those places, let alone is willing to lie on the bottom of the floor and physically scan SKUs to upload into an online infrastructure that doesn't have APIs and can't integrate with others. And so the market structure of these players who traditionally own 20% plus of what is a $10 billion plus product market is fundamentally changing, right? So on average, a little bit more than 2 million couples in the US get married. They on average invite 135 people as guests, and the average product registry is 5,200 plus, depending on the survey. So if you take those 2.2 million, you times it by the 5,000 plus, you have 10 billion in actual spend that is now totally shifting. And so what we look for to own that life stage is what's a better solution for couples that more holistically delivers around the needs of this millennial family. And for us, it's dropship enabled, it's convenient, it's digitally native. And also then, it's great to be all those things, but it's also great to have a contribution margin positive business that can be much broader. And so the way that the registry economics work enables you to build that mind share in a positive way, while then building out other products to capture the much broader life spend. And it's not about necessarily growing with the couple for 6 to 12 years and becoming, a fully integrated family management tool. There's nothing like that. But if you look at what happens in a wedding, it's already over 100 billion of spend. So buying the ring, 10 billion, right? Book vendors, registers, guests, saving the date, buying dresses, tux, going on the honeymoon, the registry. Forget furnishing a home and throwing a baby shower and doing a register there. That's a lot more in spend. But when we think about what's the most profitable wedge to own the core $100 billion market as the market structure is evolving, the business like Zola.
And let's go deeper on that industry in general. Like how would you say the industry has evolved in the past decade, and where is it likely to go? And then why is it an industry that so many VCs have passed over? Like what did they not get or appreciate?
Well, I think it's, most VCs, the reality is co-parenting and the way the world works today is very different than the way that most VCs grew up. And so if you talk to most partners at firms, I'm not sure they did their own registry. But if you know how relationships today work, and, my partner is a co-founder of a company that I'd like to plug down the road on this podcast. She's not doing this alone, right? We have much more parity in our relationship, and the expectation is on me to contribute across the household. And so I actually think the user experience in today's venture market has created this perception of, well, I don't get that because I never had to do it. And so that combined with the fact that on the surface, people have a framework of, well, this is a one-time acquisition, I think that's created this historical consensus, in my opinion, lazy view that, one-time acquisition marketplaces are less interesting than multi, and I would take the other on that. And I have a bunch of case studies, but if you look at there are companies like Redfin, which, one-time acquisition, you're buying a house effectively, you probably get married around the same number of times, or used car marketplaces like Carvana that are now public. I think are good case studies on how to take the other side of that bet in a non-consensus way. And I think that's what some people have missed over time. And I think hasn't happened in the past is drop shipping for the 1.0 generation of businesses was not a thing, right? Until 5-6 years ago, most of these brands that are actually on Zola today weren't drop shipping because that wasn't part of the industry structure.
What do you think about Joy or some of these other approaches that are trying to take the market?
Yeah, I don't, to my knowledge, Joy doesn't have a registry business. And kind of that's what I mean when you think about what is the right wedge, right? And so for us, when the average American is spending $5,200 plus in ASP on products that are sold through a registry, it suggests that there's, your margin is my opportunity, right? And that market structure around product registries, if you do it the right way, is the right economic entry. I think the reality is it's very, very hard to do. You have to build proprietary dropship technology that is integrated with payments, that has a data platform that speaks to, I think there are now over 50,000 SKUs on Zola with, 900 plus registry brands and, retail partners like Crate and Barrel who have publicly moved on thousands of SKUs to their infrastructure using it in effectively like AWS because they haven't built this stack. And so the last I looked at Joy, they didn't have that. And, we think the businesses that do are the ones that will accrue the most value over time.
You also mentioned that you and your team have a deep understanding of paid marketing. What do you think y'all understand that others don't or don't appreciate as much?
Yeah, I don't know if it's that don't appreciate as much, but we focus on it a lot. And so if you look at the historical investments of our team, the majority of those businesses were not acquired via not acquiring customers via paid marketing, right? So my partner Jesse led an investment in Headspace over 5 years ago. At the time, they had acquired over 150,000 subscribers with little to no paid marketing. That's, if you think about what Barstool has in this captive fandom that is highly engaged, they can reach a scale, actually, in some cases, turn profitable without needing to be dependent on these other channels that generally rise, in lockstep with ad spend. And so a lot of the businesses that we are passionate about aren't competing for the same audiences on Facebook or Instagram or Google, because in our personal view, finding the levers around organic growth and driving nuance and virality and buzz is much, much more interesting. And so a good example of that is a business called Meat Eater. They have a show on Netflix. They have over 4 podcasts. They have an O&O website and a big social presence. But Steve Ranella basically built what was initially a hunting lifestyle business with incredible authenticity, used content to drive commerce. So that purchasing of branded retail items, purchasing of hunting gear. We acquired a company called First Light, paid educational classes and how to related to the activities of this community and how they wanted to grow, but using his own content business to act as the top of funnel for e-commerce. And so effectively decreasing the level of paid advertising or paid social that they would need to do to scale. And when I say, we've learned to appreciate and leverage those nuances, it's a pretty consistent theme across our portfolio. And because of those insights, frankly, and, in some cases like media, really building the business plan together. In the case of Headspace, I think we were the first institutional investor and subsequently meaningfully invested each and every round. Those learnings are, in my opinion, kind of priceless, and the way that we leverage them to make the entire firm's portfolio better is, I think, something that sets us apart.
Totally. So we talked about the wedding industry. Let's talk about fertility, and that's the other part of your owning a life stage. Having a baby. Why don't you talk about your thesis there and how you've invested and looked in the space?
So I've been focused in and around the space for some time. We tinkered on medical tourism marketplaces in and around IVF years ago, to exploring and helping my wife when she was starting Kindbody in the early days, to backing a business called Daddy earlier this year, which is a men's health company today, where the core offering FDA licensed at-home fertility tests for sperm storage and analysis. That really looks to their initial wedge is providing men with this simple, accessible way to understand your own reproductive health. And so what does that even mean, right? Like, most people who've started to play in this space know that the day you're born as a woman is the day you have the most eggs in your life, and the slope of your ovarian reserve looks like a downward shaping curve. And so you see degradation over time, which impacts live birth rates and leads to other effects. But what most people don't know is that the slope of a male curve also is steep. It just is less steep, but knowing that slope can impact your decisions and life choices. And male factor infertility, depending on the study, impacts your success as leading to a live birth, whether it's through ART or through natural causes, ART being assisted reproductive therapies. And so a big part of our thesis was, look, you have this increasing need, right? Couples are getting married later in life and starting to have families later in life, combined with this larger social acceptance surrounding ART, these assisted or alternative reproductive therapies. And male fertility has not only been underfunded, but has been kind of a captive cause for a lot of the challenges that have happened for couples looking to have their first or subsequent child. And so the change in awareness and intent has created this market shift where a lot of the supply is coming online, because historically, if you were a male looking to conceive, you only found out that you were contributing to the problem most often after you've paid tens of thousands of dollars for your partner to go through an IVF treatment cycle. So you've pumped your partner with hormones. You've gone through the emotional, financial burden and psychological burden of trying to retrieve eggs. And then, you have challenges post that process because of what you see in your semen analysis. And so we felt that there was a real need to develop a premium brand and value proposition that was much more convenient for the other party that, in a world of co-parenting is also needed to build a family, right? And so I think our view, which was a little bit non-consensus at the time, was that this will be a much more significant market. The existing market is the couples that are participating in ART and embryo preservation, and men who are either curious about their fertility or participating in sperm banking separate from ART. But in reality, when you look at the data of the underlying business, the many of the people who have expressed who they are to make us build a better, more consumer-focused value prop for them don't fall in those buckets, which is really, really interesting to see. And so I think when we thought about the market, we thought a little bit about what is a contribution margin positive recurring service that is differentiated as a wedge. So in this case, when you're doing sperm banking, it's recurring in nature. It's a better service because traditionally you have to go to a clinic or center, which means you miss work and you put on a gown and you often watch softcore porn and then you excrete into a cup. Having something in the comfort of your home with on par preservation rates is a much more convenient, let alone affordable solution, which daddy is a fraction of the cost of the traditional visit to one of those centers. And so we felt the price to value combined with how the market was changing, combined with what is daddy's longer term roadmap, which is a much broader family planning tool that's data driven, is pretty special. And just to touch on that last bucket, when you get your fertility report back and you see your sperm swimming under the microscope, they are actually classifying those factors for you, right? So factors in the broadest sense are everything from pH to head shape to motility. And they don't do all of those factors today, but there's a subset that they do. And when you think about the next generation of IVF, it's a form called ICSI, which, without getting too technical and teaching a bio class here, they basically take one sperm, put it in the egg, and cut off the tail. And in many cases, that leads to better live births. And because of that, if you could potentially, not that they do that today, but if you're setting up a business and infrastructure where you're letting people know this information, you're enabling them to make better decisions and have better relationships because they're not putting their partner through another cycle, which can be financially stressful and emotionally stressful, and hopefully leads to better outcomes. And so while that is in the early days, we think it is a very differentiated, very long-term, data-driven family planning business that is going to have a big impact on the ecosystem.
So we're talking about fertility. There are companies that have sort of taken different approaches. There are people who are building IVF clinics. There's sort of modern fertility and their approach. There are people who are building sort of B2B benefit products. How do you think about the different players in the space, or what sort of different beliefs do they have about the world, or what are the different approaches in building big fertility businesses?
Yeah, I think so. When we think about it, there's a couple of factors, but because we care about price to value and we care about unit economics and serving the underserved, that really led to this investment at Thesis and Daddy, because there's this recurring nature component and a lot of nuances in both the economics and then where the product can scale to. On the clinic side and some of the other things that you referenced, generally the lower margin businesses, so things like brokerages, have historically been less interesting to us. We're a consumer-focused firm. Things that we feel are, a lot of businesses are making, say, an AMH test. And we think that if you're taking a test that can be done from a Quest and a LabCorp and, dressing it up differently, that's great. And you're making it more accessible. But when we think about the unit economics longer term, we find different types of models that are more interesting. And while I haven't looked and seen every clinic, my wife, Joanne, is, a co-founder of Kindbody. And I think one of their insights in the early days was a way to not only change the economic equation for patients, meaning bring down the cost, but deliver the most care and remove the paternalism and some of the other challenges that when you survey women who've been through this, they faced. It's really building this for women by women brand, and then being in the provision of services. And that is a very, very difficult thing for a startup to do because there's a lot of licensing requirements around that. You have to, in the case of fertility, right? Like if you're in the provision of services, that means you have REIs on staff, which are reproductive endocrinologists. You know, that is akin to going to vet school in terms of the limited pool that exists in the U.S. And those are very special people that do a lot of great work and have paid a lot of dues. So convincing them to, you know, flip a cash flow stake personally in a clinic that they either own or will own over time for illiquid seed equity is not an easy thing to do. And so if we focus a lot, and if you're in the provision of services with this roadmap, are you doing it with the right people and the right approach in a way that is consistently building value on both sides, meaning for the patient and then also for the brand? And, you know, we think that there's a lot of interesting businesses out there doing that, and it's going to be a fascinating space to watch.
The other space in the own the life stage space is funerals or end of life. So why don't you talk about your interest there? People have tried to build a business there for quite some time. Maybe you could talk about, you know, what's happened there, or why it hasn't happened there, and where we are right now.
Yeah, I mean, so death care broadly as an ecosystem is just fundamentally broken, yet highly attractive, right? In the sense that it's large. You know, there's 20 billion of spend that goes through that market. There's growing demand. It's recession proof. Unfortunately, there's today roughly 2.7 million deaths per year, and that continues to grow. It's been highly fragmented in the sense that, unlike other better for you businesses for consumers, the mom and pop intricacies of the 20,000 funeral homes that own and operate 85% of these assets has created a really bad experience, right? You know, they're opaque in pricing. They can be predatory at times. They can, you know, use that pricing to drive profitability. If you've looked at rolling up any of these, they have 40% plus EBITDA margins. And because of that opaque and market structure that's protected on a sub-muni basis, meaning the restrictions in parts of Long Island are different than parts of New York. In different states, you can have a retort, which is where you burn the bodies on site, with a cemetery, and others you can't. Creates a lot of nuances that has actually not served to help the industry, or, you know, it's kept private equity out historically, and that's made it be run by these legacy incumbents that are typically third or fourth generation families that have no incentives to change. It takes a special person to want to be a mortician. I don't know if you spent time with any, but they are typically, let's just say they have that position for a reason, and I encourage you to. And what's happened in the U.S. over time that really drove my interest in the space is, you know, I have a friend who owns one of the largest funeral roll-ups in the Bible Belt. And what they started to talk about when we were having dinner was actually this shift in cremation representing the most significant issue facing the industry, arguably ever. And so what that meant for him is that most of the homes that they were owning and operating were built for funerals, not cremations. And when you look at how the market has changed, so in the U.S., roughly, you know, in the 90s, call it 95, 21-ish% of deaths were cremations. And last year, it was roughly 52%, depending on the numbers you look at. And if you look at countries like Japan and Switzerland, they're actually over 98% cremations. And I think the U.S. will rise to 80% plus. And so the thing I couldn't shake at night was how broken this experience is for the consumer, how much the market is evolving, and where we are, you know, as an inflection point for what that means for building a new business in the space. And so, you know, initially my thinking was really focused on what's the best way to do it, right? And so everything from incubating a D2C business that we think does this in a better way to looking at doing more majority investments with where you can build a consumer brand on top of a existing asset that has the right licensing and infrastructure for you to deliver on that promise to a family, to even, natural burials and ash spreading. And what we found is that there's a better way to go. And, we are actually, when you think about, the legacy you live, most people, if you survey them, they're not necessarily sold on going back home, whether that's to Westchester or what you talked about, which is, where your family's relocated, right? And so the secular shift in the U.S. has created this disassociation of identity from just the town you were, say, going to elementary school in. And that's created a big opportunity. And without oversharing a deal that's unannounced, we found that using that and tying where a person celebrates and has an end-of-life experience to a more iconic region in a much more sustainable way, think things like ash spreading, is a much more attractive value prop for both a family, right? So instead of being buried on a highway next to, if you look in New York, when I'm looking out my window, you can't really get a burial plot for a reasonable cost, right? They're tens of thousands of dollars in Manhattan. And what we found is that there's a better way to solve that price to value equation for consumers. And I'm excited to announce what we will be investing in, over the months to come. But you'll be the first to know. I feel like we should do it together with the company.
Perfect. So when I think about other things that could potentially fit into this thesis, is finding a life partner in that, and I'm curious how you view sort of the dating market generally.
Yeah, I think it's pretty special to see how, if you think about some of these trends, right? So like co-parenting and gender parity actually expresses itself through really special dating businesses like Bumble, where the power dynamic has been shifted, right? And we actually are huge believers that is creating a new set of companies that will better serve the needs of a couple with the engineer who designed it, who potentially was most likely not that woman, right, or of that psychography. And so we're very excited about subscription products like that solve a real need in that life stage. I think the tricky thing with dating is when you think about the other businesses we're talking about, like whether it's ARPU, right, or ASP, whether it's the 5,000 plus basket size and what that means for contribution margin, or potentially a higher number in what people have historically spent on traditional funerals, like the margin structure is important to driving long-term value. And a lot of times these brands haven't, on the dating side, I've found, don't have the leverage to price in that way, which doesn't benefit the venture investors in the way that they may think about the life stage.
Are there any other stages that you could see, or spaces that you could see joining this thesis?
Yeah, I think there's a lot. So we talked briefly on gaming with businesses like Roblox, and I think that's really special. Historically, there have been brands built in and around even things like sports, right? So if you look at a business like Barstool Sports, that if you think of what Howard Stern was for initially really college age Gen Z millennial audiences, they built that in a really special way. And most people generally are of that age in and around the college demographic. And so I think there's a bunch in media brands that can be done well. The question comes down to, is that monetizing in a way that is attractive, right? And so, we don't really back ad-supported businesses, and I'm not sure those are best built for venture scale and outcomes, but there are nuances around companies like Barstool where you have tens of podcasts now and a big O&O presence. You have events, right, and merchandise, and those are big standalone P&Ls. So events are things like Rough and Rowdy in the case of Barstool. They even have a subscription business called Barstool Gold that has done phenomenally well. And so when you think about building this diverse, simple yet organic content to commerce model that owns a life stage, I think they're actually a really special case study as well. We could talk about this for days.
Let's talk about Shop Shops and why you got so excited about that business and the broader space generally.
Yeah. Do you know much about it?
No, please introduce it.
The way that they came to market was really around this cross-border e-commerce application that sells products held on live streaming events. Now they also do replays and other events, but initially live streaming at retail stores. So if you think about the best next generation of brands, right, like a business like Everlane or Warby Parker, or even higher end merchants like a Theory, they barely have the CapEx in Soho for one or two stores. They're not going to build out a large footprint in Beijing or mainland China, but they want to tap that market for e-commerce because it's the largest in e-commerce, much larger than Soho. Sorry to my New Yorkers, and it's the fastest growing. And so historically, the way that these businesses have been selling into those consumers is through live streaming, and most of it happens on Chinese-owned assets like Tmall or Taobao Global, where it's a person in a city live streaming in their parents' room and laying out all of their Warby Parker glasses or lookalikes on the bed and putting that on their WeChat mini program. And what most consumers struggle with is they want to own that brand, but they want, a higher fidelity experience, right? They want to touch and feel and have an interactive component to it with somebody that is either a key influencer or is higher fidelity in the sense that making sure it's authentic. And what Shop Shops crack the code in is building this three-sided marketplace. So it's not just brands and consumers. There's actually a host component to it. And that's really unique because it also means that Shop Shops acts as a labor and credentialing system. So when the business started, the first hosts resembled something called a Daigo. And without getting into Chinese market structure, these are groups of what has historically been women that leave the mainland and actually go out, procure goods that their clients want and bring them back. It's historically been a gray market, but if you Google Daigos and Shiseido, the Japanese skincare brand, you'll see that it's a very well-known thing because the way that the regulation has changed has now led to a massive drop in, Shiseido sales into China. And what Shop Shops came about with, which is really almost like a host product that let those people do their business in a better way. And that's where the credentialing came in. And so they're setting them up with the brand. In this case, it's a Chinese national or Chinese American that would go down to Theory or Everlane or a store in Soho and stream it at 8 a.m. in New York. It's 8 p.m. in China. And they'd stream US to China. They do a session that's curated with the brand's consent and with the brand's influence. And that's pretty special because if you look at the larger businesses, even the publicly traded ones historically like Michael Kors, when they actually went into these markets to tap them, they talk about in their transcripts the lessons learned. And one of the two biggest lessons learned are it led to massive price erosion and degraded brand quality. And that's because they couldn't control the channel effectively. And so brands pay a significant take rate to Shop Shops to effectively do that because they are comfortable with the fact that it is not cannibalizing their existing business since all of these sales have largely been net new. And so over time, right, it's been really special to see Shop Shops, host these events, get millions of views, build a multi-platform product. So they now have their own standalone app. They have a business on Taobao. They have a WeChat mini program, partnerships with all the large streaming assets, and seeing merchants come back and stick with them in a way that has continued to scale GMV and fairly contribution margin positive has been special.
And how have you viewed e-commerce or e-commerce enablement more broadly as a VC? Is that a space that you've been looking at or find interesting in the future?
For sure. A few years ago, I worked on carving out a business initially from Flextronics that became Auto. That company today is called Bright Machines. They are led by the old Autodesk leadership team, And the way that we thought about e-commerce infrastructure is really, in that case, expressed through, if you're Nike and you want to spin up a new product line, but you can't build another factory in an XYZ country and hire hundreds of thousands of low-cost labor to do it for a variety of reasons, how do you flip that from a CapEx outlay to an OpEx outlay? And that is manufacturing as a service. So leasing effectively a smarter machine, that's hence Bright Machines, that gives you not only more control to scale up and scale down with SKU production and shifts in the product roadmap, but also a more viable economic model in a world that's a tight labor market, while enabling you to do the right thing, has been one way that we've expressed it. And Bright Machines has done phenomenally well. The team there continues to build software on top of the hardware that they give to these manufacturers, and they work across consumer products, everything from electronics to firewall hardware to autos to healthcare devices. Manufacturing as a service has been historically, a good way that I've expressed that in the past.
We've seen this sort of Warby Parker for X moment where VCs were funding sort of everything that looked like Warby or Dollar Shave Club for different categories. How have you viewed that sort of D2C space broadly? Like, where is it interesting?
Yeah, so I'd say like there's a couple of factors we look at, and maybe I could talk about those and talk about some of the spaces that I think is still emerging and interesting. And so I think about market structure, right, and margin as a really important setup for success. And so you brought up Dollar Shave Club, and what was special there is, Gillette and Schick make these blades for 6 cents on the dollar, and they resell them for $2.70. And so you have that huge spread as a brand to play with in delivering a better price to value. And that is not true of every category. The other thing that is not true is the way that patents work and the way that market share has historically been driven with way back in the day when Dubin was first starting building that business. It was historically really 90% plus Gillette and Schick. And so I think that creates opportunity, particularly when you have a margin profile like that. And in the case, since you brought it up, Dollar Shave Club, it was really, he was doing his own commercials, shaving in Central Park, starring in his own go-to-market plan. And I think that level of scrappiness and authenticity is replicated by few. It is replicated by, great leadership at things like Glossier, but, it's really, really hard to do in an authentic way. And so not every category does have that. I do think more broadly, there are categories like within health and wellness, whether it's collagen or morning recovery, products and hydration, or brands around a non-alcoholic movement and a different preference set for Gen X, Gen Z, and millennials, like whether that's kin or otherwise. There's a lot of opportunity there. But within the same category, reinventing it with a marketing veneer is not attractive. And I think we've historically not focused on those types of businesses. We focused on ones that have different characteristics. And so a couple of ones that we think are particularly interesting are where there is repeat buying in the right market structure with the right margin profile. So you mentioned the razor blade businesses, but whether it's Quip or MeUndies or Glossier, on the subscription side, that makes things incrementally more interesting. The right way to think about simplicity in your product offering, I think, is special. Not being afraid of coupling digital and physical experiences to drive the flywheel. So, the SIL, Stadium Goods, right? Like Stadium Goods is a hybrid online and retail model from the beginning. So they combine what's really an elevated customer experience with sneaker resale. And I think developing omni-channel in the right way definitely is a differentiator. And so there are factors like that where we think are lessons learned in scaling these consumer businesses. And while, history doesn't repeat itself, it rhymes. And we are aware of kind of the nuances in it. But at the same time, to your point, like growth looks different for each company. There's no one size that fits all. And so when to expand the team, which is critical, is an important nuance. And I think, oftentimes the categories that we avoid, when you look at the factors that we've talked to, they haven't, in our opinion, approached those questions in the right way. And so when we think about direct to consumer, we actually think that maybe what's less interesting is some of the lower hanging fruit in the product categories, or what is actually interesting is serving a more underserved need. So if you think about like a direct to consumer subscription experience that's peeling off of Facebook or off of a community, that's interesting to me. So a good example is Chief, if you're familiar with that business, clearly very underserved in the communities that they're building for women leaders of organizations across types, but they're doing it with the right economics and that they have a high ASP and really strong retention because they're actually serving an unmet need. They're not selling you XYZ good, which you could have gotten at a similar price and a similar value some other way. And so I actually think I pivoted my thinking a little bit towards those classes of companies. And in a way, it's almost owning a life stage, right?
Totally. Another space you've thought a lot about is consumer health more broadly beyond fertility. How have you seen, or where have you looked there? Where is interesting to you? What's not interesting to you? How do you sort of think about the rise and future of consumer health?
Yeah, and so I think there's a lot here. I think the most interesting thing at a macro level is that, like retail, media, and even travel, right? Healthcare is on this cusp of a 10-year digitization wave that is going to, in my opinion, transform the way that products and services are discovered, are marketed, are sold, and then also driving down the costs and improving the experience. And so if you have that lens, the question then becomes, what is the right way to play it, and where are opportunities? And so we found that there are a couple examples where in healthcare, there's systemic underconsumption of certain services because of these consumer pain points, right? And so if you think about orthodontics or dermatology or hearing or hormone therapy, there's very low penetrations because of how much friction is in the system, whether it's from a price or value or ease of use or experience. And so we've looked at those macro end markets, including fertility, to find ways that we can kind of back teams where they're lowering costs for better fixed cost allocation, right? So if you have a more efficient service model like telemedicine, that's one example of how to do it, where they're increasing convenience, right? Whether it's an on-demand model that better caters to a certain patient population, like a city block, which we're not investors in, but we think about those models a lot. Or you can really scale content and through modern marketing, better educate people who don't see their orthodontist or who don't think about hormone therapy as a way to solve a consumer pain point. And so, we focus on the consumer side of backing those teams and brands that stand for solving those things in a way that also stands for trust and lowering the costs and the emotional burden of a lot of those pain points. And we think, we're in early innings of that trend, and I think you'll see a lot more there in the years to come.
Is there anywhere even broader than that in consumer that we haven't discussed, any subspace or category or type of business that you're looking for or particularly excited about or could be excited about soon?
There's a few. So when we think about B2B2C businesses, right? So companies that have almost had a SaaS-like product that use the vertical ownership they have and create a network around that it pivots to becoming a marketplace, right? And so one example of this that's been thrown around is like Airbnb's host calendar is effectively a software-like product that has built this network. And then they built this two-sided GMV-like marketplace on top of it. Ariba on the procurement side is another example. There are a bunch of analogs in travel. We've started to see it in e-commerce where in the case of shops, you're delivering a better product to a host community. And that's created this network almost like as a service component, which we're particularly interested in because it almost has a recurring foundation that's built in. I think in parallel and broader content, we are spending a lot of time in and around native audio and other types of content networks. So whether they're purpose built for AirPods and products and subscriptions related to that, we feel that there's a lot of opportunity around this form factor shift. And then outside of the one area in healthcare we didn't talk about is the patient experience. That actually creates a much more defensible provision of service, right? And so we talked a little bit about, part of the value in Kindbody is changing the power dynamic where you're providing for women by women experience that remove some of the paternalism in that industry. We think that is a very defensible thing for a brand to do. And we look to back teams with that level of authenticity. And then in broader health and wellness, I mentioned collagen and superfoods, but I think related to that is the best models we've seen have either had some sort of Gen Z or youth-driven culture brands. So whether it's things like, Kyra TV, right? Or other naturally viral products like Recess. We've spent a lot of time there, and related to the people who are building those brands, they're creator economy tools. And so Chartable, FitPlan, Carrot, businesses like that, we made an investment in Cameo earlier this year to express that. And it's led us down a really interesting place to invest. And we think personality as a platform is going to be a thesis that compounds over time. So not just things like Marie Kondo or Meat Eater or Food 52, but Perfect Keto and Bigger Pockets and Huda Beauty. We're spending a lot of time there. So if there are any special people building platforms, this is a request to spend time with you. We've been doing a lot of that over the last 10 years. And, we think we've learned a lot and would love to share and get to know teams like that.
And what do you think about these sort of, social clubs or communities that VCs are now backing? Soho House valued at $2 billion. There seems to be Soho House for X, or the sort of in-person communities that are sort of reactions to the increasing sort of fragmentation and digitization of our relationships. Do you think that any of these sort of, there's the Wing, obviously, which we work for women. Any of these are likely venture scale?
Yeah, I think the ones that are similar to Chief in a lot of ways, and similar to the things you've talked about with Balaji and the community building that he's thinking through, where you're really finding an underserved market. So the Soho House for kids or grandparents, I'm not smart enough to know that's underserved, but I do know that there's a huge drop off in women leadership at the VP level and at the C-suite level. And I really think that's for a reason. And so I think that's an underserved market where if you build the right community and network, there are proven benefits. And so I think about what is the market that you're in, and do you have the economic model that leads to venture scale with the right product offering? So on the economic model, we talked about retention, right? Where you have things like YPO that are 90 plus retention. I don't know that every, Soho House for X is similar, but I do know that if you're serving a underserved community, like some of the ones that we've discussed, you should expect in that leadership and talent pool to have high retention and a very profitable business. And there are a few examples on the public side of businesses like Vistage, which is owned by Providence Equity Partners, that, has hundreds of millions of revenue, 20K members plus, and throws off tens of millions of EBITDA. And so when I think about venture outcomes, I think about hundreds of millions of revenue and, a proven path to get profitable. And I think you have to be playing in markets like that. But the nuance is really, less, I think, around there and more, what are the little things you do for your community and in your product to build that type of business, right? And so I think that's the part that a lot of these Soho House for X, as you call it, don't get right. And so you're not doing the right salon series or professional workshops or private dinners, and you're not leveraging events to drive awareness and membership sales, because like we talked about, word of mouth is a much better channel that scales in a more efficient way. And so I think that combined with tying it to a digital component, which a lot of these businesses miss, is the other part of the equation where you want some level of one-to-one member messaging, right? As if this is going to be a truly third space, right? And for, a consumer, there has to be that level of trust. And so that can be expressed through a digital application that's given to the entire community where there are private channels for some sort of need. It could be through a member site that's akin to the first round network that people talk about. But I do think you have to think about the product in a much more holistic way. And from the Soho House for X's that I've seen, they're generally more vanity plays for those members and, status as a service, as opposed to, in my opinion, solving a real need in a profitable way with a better product.
Yeah. In closing, is there any sort of request for startups for things that we haven't discussed here, or spaces or categories or even niches that you'd be interested in seeing more entrepreneurs explore?
Yeah, I think I've given you a lot, but you tell me. I think if any teams are building brands in health and wellness around those categories, I'd love to chat with them. If folks are thinking about subscription-like models that peel off of Facebook in a way that, whether it owns a psychographic or a life stage, I think that's particularly of interest to me. And owning a life stage in a way that is similar to gaming or death or weddings like Zola, we'd love to spend more time with. And so, I talked a lot about those and SaaS as a network, and I think that'd be a great place to start.
Perfect. My guest today has been Marco DeMeireles of TCG. Marco, thank you so much for coming on the podcast. If you're an early stage entrepreneur, we'd love to hear from you. Please hit us up at villageglobal.vc/network catalyst.